We're going to focus on managing a portfolio as we move on now to this notion of portfolio allocations and diversification. All right. The typical investor is concerned with exchange traded securities. We're going to talk about non-securities and why they may be useful to include in a portfolio as well. But for the most part, we're going to focus right now on exchange traded securities. That does not mean this does not apply also to non-securities. In fact, everything that I said herein also applies to non-securities. So let's start with this idea of an allocation. All right. Some securities that you may hold in your portfolio: stocks, bonds, ETFs, mutual funds, options, futures contracts, and REITs. What I want you to see here in this particular animation is this idea of diversifiable risk. Okay. On the left, what you're seeing is a single stock. If I hold a single stock in my portfolio, you can see my entire portfolio value is just subject to wherever that single stock moves. Versus if I have a portfolio of tech stocks, you can see that the individual risk of each firm is what we call diversified away. What that means is if one firm does very poorly, you can see this particular firm, stock 4, was this a 40% drawdown at the end of this year, but the portfolio itself is actually up 10%. So diversification is going to say, okay, we're not going to experience as much of the upside on some of these moves, but we're also not going to experience some of the downside on these other moves. So you're diversifying away specific components of risk. So if I have a single stock, then I'm holding all of that firm's risk. If I have a portfolio, say, of tech stocks, then individual firms like Google or Microsoft, they're not going to carry my entire portfolio in one direction, but that sector as a whole certainly is. So if tech underperforms, then my portfolio is going to do incredibly poorly, right? So you can then diversify away your technology risk, and then you get a broader market portfolio. This is like the S&P 500, VU, all of your different standard market ETFs. But the most important thing to understand here is you've diversified away different facets of risk. You diversified away this single firm, this idiosyncratic, we call it, risk. You diversified away this tech risk, this particular sector risk. What does that mean you're left with? You're left with this broader market risk. That is this notion of diversifiable versus undiversifiable risk. Here, you're looking at single stock exposure and tech exposure. Both of those are diversifiable. I can hold more firms outside of the tech sector to diversify away this tech risk. If I have a single stock, I can just hold more stocks to diversify away that single stock, that idiosyncratic risk. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, QuantGuild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to QuantGuild if you're interested in these free resources.